Upstart stock is down about 15% after they've announced their Q2 2022 results, in which they missed both the revenue as well as earnings per share estimates. The revenue was missed by about 3%, but the earnings per share estimate was missed by about 85%. The street was expecting 8 cents profit, but they only made about 1 cent profit. The stock is down because of the forward guidance, in which they are predicting that they would make about $170 million of revenue in Q3, but the street was expecting about $245 million. Also, for the past few quarters, they made profit, but in the coming quarters, they're expected to make a loss. There is also about $100 million of stock-based compensation that is due. Because of all these reasons, the stock fell significantly. This stock is down about 80% in the past 1 year, and it teaches us a lesson that we need to really learn about the business model of the company rather than investing in a stock because of its growth. Upstart stock went to about $390 primarily because they continue to execute very well and have very high growth and also making profits. And Upstart claimed that their AI program originated loans are 75% less likely to have a default payment compared to a loan originated from a traditional way like a FICO score. So a lot of lenders got very interested in Upstart because they want less default payments. Also, Upstart was very confident that they took a step ahead and put the loans on their balance sheet. And everything was going well for them. They have been growing and making money. Right? About 3 to 4 months ago, Upstart CEO said that their AI program was not working as good as before. And he's saying that that's 75% less likely to have a default payment is probably because people are getting stimulus checks and they are on time with their payments, and it has nothing to do with the AI program itself. In addition, Upstart CEO also mentioned that their AI program is not as effective when it comes to varied interest rates. So in the current environment, the interest rates are constantly changing, and it looks like their AI program is not very effective in such cases. So indirectly, he did say that we should expect some degraded performance, and that is probably why this is one of the most heavily shorted stocks with a 35% short interest. Usually I do a stock price prediction 5 years out by extrapolating the revenue growth, but at the moment, since their AI program is not as effective anymore and they are working on a new AI program to deal with the current situation, I cannot do an extrapolation of their revenue growth as well as profit, because in the coming quarters they are expecting that they may post some loss, right? So because of all this mess, I'm not going to do any stock price prediction. However, I'm going to follow the stock in the coming quarters to see if they fix their AI program to deal with the current situation